Hello, and welcome back to the channel. I'm Algabot, and here we break down automated trading strategies for MetaTrader 5, one piece of logic at a time. Today we're studying an expert advisor called Rsi Swing Breakout. It pairs a single momentum indicator, the relative strength index, with pure swing price structure to trade breakouts in the direction of the prevailing move. By the end of this video, you'll understand exactly how it reads momentum, how it spots a genuine break of structure, and how it defines its risk. Remember, this is educational analysis only and not financial advice. Let's get into it. So what exactly is Rsi Swing Breakout? At its heart, this is a trend continuation breakout system, and it deliberately keeps things simple by using just two ingredients. The first is the relative strength index, a classic momentum oscillator. But here's an important twist. The strategy does not use the relative strength index in the usual way, hunting for so-called overbought or oversold extremes. Instead, it reads the indicator against its 50 midline to judge which side currently owns the momentum. When the reading sits comfortably above 50, buyers are considered to be in control. When it sits below 50, sellers are considered to be in control. The second ingredient is pure price structure in the form of swing highs and swing lows. A swing high is simply a peak that stands above the bars on either side of it, and a swing low is the mirror image, a trough that sits below its neighbors. These are the levels the market itself has defended, so the strategy treats them as live support and resistance. The expert advisor only takes a breakout when momentum and structure agree. It waits for price to close decisively through one of those swing levels while the relative strength index is already leaning in the same direction. This is what helps it step around the choppy, directionless breakouts that so often fail inside a range. Because the risk is built entirely from price structure rather than from fixed pip or point distances, the same logic can be applied across different symbols and time frames. The author suggests trending markets such as the British pound against the US dollar or gold on the 15-minute or 1-hour charts. It will suit a trader who is interested in momentum and trend continuation styles. As always, this is educational analysis, and trading carries real risk. Let's walk through the mechanics step by step. The expert advisor works on closed bars, so it makes one decision each time a new bar completes, rather than reacting to every tick. On each new bar, it first updates its picture of structure. Using a setting called SwingHalfWidth, which defaults to 3, it confirms a swing high when a bar's high stands above the 3 bars on each side of it, and a swing low when a bar's low sits below the 3 bars on each side. The most recent confirmed swing high and swing low become the live resistance and support. Next, it reads momentum. It calculates the relative strength index over 14 bars and compares it to the 50 midline, with a buffer called the MomentumMargin, which defaults to 5. The regime is considered bullish only when the reading is at or above 55, and bearish only when it is at or below 45. That small margin keeps the strategy from flip-flopping when momentum hovers right around the midline. Now the entry. A long setup is signaled when two things are true at once. Momentum must be bullish, and the freshly closed bar must close above the most recent swing high, while the bar before it was still at or below that level. That second detail matters. It makes the move a genuine, fresh break of structure, rather than a late chase of a level that price left behind long ago. The short setup is the exact mirror. Momentum must be bearish, and the bar must close below the most recent swing low while the prior bar was still at or above it. Risk is structural. For a long, the stop loss is placed just beneath the most recent swing low, with a small buffer set as a fraction of the breakout bar's range, controlled by the stop buffer fraction. The idea is straightforward. If price falls back beneath the higher low that defined the up leg, the continuation idea is no longer valid, so the position is closed. The take profit is then set at a fixed multiple of that stop distance, defined by the reward ratio, which defaults to 1.8. For a short, the stop sits just above the most recent swing high, and the target is again a multiple of the risk. Two final guards keep things clean. The strategy holds only one position at a time per magic number, letting the structural stop and target manage the exit, and it skips any trade when the current spread is wider than the max spread point setting. Together, these rules aim to keep entries selective and the risk clearly defined. Here is the heart of the strategy as it appears in MetaTrader. At the top are the inputs you can adjust in the Expert Advisor's settings. RSI period is set to 14 and momentum margin to 5, so the bullish line sits at 55 and the bearish line at 45. Swing half width of 3 defines how many bars a pivot must dominate on each side. Stop buffer fraction, reward ratio, max spread points, lots and magic round out the list. Just below, the code sets 2 flags from the relative strength index of the just closed bar. Bull regime is true when the reading is at or above 50 plus the margin. Bear regime is true when it is at or below 50 minus the margin. Now look at the long block. The Boolean called fresh up break is true only when the signal bar closes above the stored swing high and the previous close was still at or below it. When bull regime and that fresh break are both true, the code reads the ask price as the entry, sets the stop just below the swing low minus the buffer, measures the risk as entry minus stop, and places the take profit at the entry plus the reward ratio times that risk. It then calls trade.buy with those stop and target levels. The short block is the perfect mirror. Fresh down break is true when the signal bar closes below the swing low and the previous close was at or above it. When bear regime and that break align, the entry is the bid price, the stop sits just above the swing high plus the buffer, and the take profit is the entry minus the reward ratio times the risk, placed with a call to trade.sell. Notice both sides share the identical structure, just flipped in direction. Let's bring it all together on this illustration. On screen, we have a candlestick chart of the British pound against the US dollar, and beneath it the relative strength index, our momentum gauge. Notice the 3 reference lines on the indicator, the 50 midline in the center, the bullish line at 55, and the bearish line at 45. On the price chart, 2 dashed levels mark the structure that matters, a prior swing high at 1.2720 and, later, a prior swing low at 1.2734. Watch the opening candles. Early on, price pushes up and prints a peak right around 1.2720, then pulls back. That peak becomes our confirmed swing high, the resistance the strategy is now watching. As price drifts lower over the next few bars, the relative strength index eases back toward and even below the midline. Notice that even though momentum dips into bearish territory here, no short is taken, because price never closes below a swing low. Both conditions have to agree, and they don't yet. Then momentum begins to build. Price turns back up, and the indicator climbs through 50 and pushes above the 55 line. So the regime is now considered bullish. On the breakout bar, price closes cleanly above the 1.2720 swing high, while the bar before it had closed below that level. That is a genuine, fresh break of structure, with momentum already leaning the same way. This is where the buy entry marker appears. The stop loss is tucked just beneath the recent swing low that built the up leg, and the take profit is set well above, at 1.8 times that risk distance. From there, follow the next 2 candles higher. Price holds above the broken resistance, momentum stays firm, and the market runs up into the take profit marker, where the long is closed at its planned target. That completes the first sequence. Structure broke upward, momentum agreed, and the trade was managed entirely by its structural stop and reward-based target. Now the market tops out, and the picture flips. After the peak, price rolls over and forms a fresh swing low up at the higher level, marked by the dashed line at 1.2734. A small bounce confirms that trough as support. Meanwhile, on the indicator, the relative strength index slides back down, crossing below 50 and then dropping beneath the 45 line, so the regime is now considered bearish. Watch the breakout bar to the downside. Price closes below the 1.2734 swing low, while the previous bar had closed at or above it, a clean, fresh break of support. With bearish momentum already in place, the sell entry marker appears. This time the stop loss sits just above the most recent swing high, and the take profit is placed below the entry, again at 1.8 times the measured risk. Follow the final candles down. Sellers stay in control, the indicator holds below 45, and price slides into the take profit marker, closing the short at its target. There you have both halves of the strategy in a single picture, a long that needed momentum above 55 and a fresh break above resistance, and a short that needed momentum below 45 and a fresh break below support. Notice what the design is really doing. The Relative Strength Index screens for a market that is already moving with conviction, and the swing break demands that price actually commit through a level the market had defended. By insisting on both, the strategy aims to skip the range-bound false breaks where a lone breakout entry often gets chopped up. Of course, no filter is perfect, and breakouts can and do fail, which is exactly why every entry carries a predefined structural stop. And that's the full breakdown of Rsi Swing Breakout. We've seen how it uses the Relative Strength Index purely as a momentum gauge against its 50 midline, how it waits for a genuine break of a swing high or swing low before acting, and how it builds its stop loss and take profit directly from price structure with a reward-to-risk multiple. Everything here is for educational purposes only and is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses do happen. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe so you don't miss the next breakdown. You can find more strategy analyses at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.